All right. Thank you everyone for attending this month's market update webinar for the month of February 2025. Let's start with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing anything discussed within the presentation. And of course, past performance is not a guarantee of future results. You can see our website for additional disclosures, and throughout the webinar, feel free to use the Q&A button to submit any questions you may have, and I will address them at the end of the presentation. A quick bio about myself. My name is Jeremy Eppley. I'm a certified financial planner, certified private wealth advisor, accredited investment fiduciary, accredited portfolio management advisor, chartered retirement planning counselor, and I have my master's of science in personal financial planning. You can learn more about me on my LinkedIn. And Silverstone Financial, the firm, is a fee-only fiduciary registered investment advisory firm. We provide comprehensive wealth management services, including financial planning, investment management, tax prep, and estate planning. You can learn more about us on our website. So unfortunately, we had missed out on the recap webinar for January. I ended up being busy at the beginning of this year, so I just want to do a quick recap of what the markets did last year. It won't be as in-depth as we normally go each year, but last year, the S&P 500 had a total return of 25.0%. So 25% in a single year is definitely a very, very strong year in a historical sense. I want to also point out that over half, 53, almost 54% of those returns, so half of 25, let's say 13%, rounding, of those 25% returns came from the top 7 largest holdings of the S&P 500. So very, very concentrated in the largest tech companies, where all the returns came from, essentially, in 2024, which also increased how much the indices held of these large companies. They already were a huge chunk of the S&P 500, and now, because they grew more than the rest of the S&P 500, they're a larger chunk of the indices, because that's how market-weighted indexes work. So we'll hopefully see that those few stocks continue to perform well, or we might have some reversals, since if those 7 best largest stocks perform poorly, doesn't really matter what the rest of the market does. The S&P 500 will definitely be falling in that case. To the right, beyond the candle chart, that's usually how financial professionals look at the stock market, where green candles means when the day is a day when the stock market went up, or the S&P 500 went up at least, and a red candle is when a day that it went down. To the right of that, you'll see a distribution of historical stock market returns of the past 150 years. And this is from 2023. So you see the 2023 box highlighted. But 2024 was in the similar range of between 20 and 30%. So 2023 and 2024 were both above 20% returns for the S&P 500, which is a really incredible return and brings into question sustainability of those levels of returns. I'm not saying that 2025 will be a significantly worse year or a significantly better year. It's impossible for me to tell that, even though I have some ideas that I'll share in the future. 2024, I think it'll be hard to see 3 years in a row of 20% or higher growth. So we might see a slowdown this year, but hopefully not, and hopefully we see continued growth, but just at a more sustainable pace. I also like to show this little graphic each month. For those that haven't seen this before, the outside circle shows the average monthly S&P 500 index return based on that month. So it shows some seasonality and cyclicality of the markets and shows that historically there are some months that perform better than other months. So seeing the markets drop in a particular month, especially October or August and September over these red months here, is to be expected. February, this coming up month, is usually a coin flip. It's about flat historically. Same with May, versus October, November, December, and January usually are very strong months. The inside circle shows what has actually happened. So far we only have 1 month of data for 2025, which is January. We had almost 2.8% returns in the S&P 500. So that's almost 3 times the amount historical average for January. So we had a good start to the year, and we'll see if that continues through February and March and so on. The last graphic I like to show for these webinars is what we call a heat map. This is how I personally look at the markets each day. The greener the box, that means the higher the return for that specific stock. And the redder the box, the worse the return is for that stock. The larger the box, it means it's a larger company and therefore has a heavier weighting in the S&P 500 and other indices. And the smaller the box, less so. So you'll see big red here, NVIDIA versus Apple versus Google versus Microsoft versus Meta versus Tesla. You can see, though, how impactful those companies are on the index. What I also love about this view is it shows it in the industries, the sectors that they're in. So you have technology, communication services, healthcare, financials, real estate, energy, utilities. They're all broken out, and you can see if there are trends going on. You can see that technology had a slightly worse month than, say, financials. Financials did pretty well, versus, let's say basic materials, which is like gold miners or chemical manufacturers, that kind of stuff. Usually their customers are industrial companies, large companies. They had quite a good month. There are various reasons for that, but it's very interesting to see the market in this way instead of just seeing a line item for the S&P 500. This breaks it out a lot more. You can see the underlying data in that rolls up into that 2.7% return of the S&P 500 last month. Well, that's true, but NVIDIA, which is a large chunk of it, had quite a bad month and dragged on that performance, whereas Meta had up 6.5%, a very good month. So each of these different components affect how the markets perform. Mega caps, which are these Magnificent Seven largest companies, had an average return of 1.7 in January. S&P 500 slightly better than the mega caps, which means the bottom 450 stocks of the S&P 500 were doing significantly better than the top 50 largest stocks because it dragged up the overall performance of the S&P 500. S&P GARP is the growth at a reasonable price index that filters the S&P 500 from 500 stocks down to the top 75 stocks that both exhibit exceptional growth and value. So growth at a reasonable price exhibits those qualities. And personally, that's my preferred investment style. It makes a lot of sense from modern portfolio theory and other financial theories and mathematics and statistics that us finance nerds enjoy going over. So in the past year, the GARP index, which again I prefer, has underperformed the broader markets because it has essentially underweight to the mega cap stocks, which are a little more expensive and have done very well historically, but because they've done well, they're expensive. So it's difficult to justify. So in the past year, the GARP index has underperformed, but at least this month, it is catching up a little bit when NVIDIA and some of the other large companies have sold off. Not saying that'll continue, but it's interesting to see. And then small caps performed about what the S&P 500 did. So smaller companies at 2.89 instead of 2.76. Ex-US, so non-US companies, international companies, outperformed the US markets. All of last year, they underperformed, and I guess they're doing a little bit of catch-up. It also might be some reaction to Trump's presidency and the corporations and the financial institutions generally trying to diversify a little bit from the US, as the US is seen as a little bit riskier, or at least more chaotic, difficult to read and difficult to plan ahead. So that's just, hypothetical. I can't say that for sure, but global ex-US, there have been some trends that I've been seeing that have come up since tariffs and such have been discussed. Aggregate bonds on average returned 0.5% for the month. Gold returned 7% for the month. That I would say is very certainly has to do with both inflation and tariffs and fear about government. Usually gold is that flight to safety. There's also, if you get into a little more deep economic reasons, central banks have moved a little bit away from the dollar, especially with the chaotic White House. So central banks are usually the largest purchasers of gold. And so European Central Bank, Bank of Japan, these large banks, I would expect will have bid up some of the price of gold here. Crude oil, flat. 1% for a change in a month over month for crude oil is not significant. And then Bitcoin being up 8, almost 9% for the month. Again, that's a monthly figure, quite a large return. That almost certainly has to do with what is seen as a more friendly crypto administration with Trump being in the White House. All right, the last slide, the main slide, I would say, that we're going to be covering tonight are the notable events that happened last month. There were 5 main ones that I found interesting. Again, it's finance news. If I included political news and everything else, there'd be a solid 20, 25, 30 topics I could cover. But focusing a little bit more on just the financial news that you might have missed, especially since a lot of the headlines have been taken over by extraneous other topics that aren't specifically headline related. The first one I wanted to discuss was DeepSeek. So there was a solid day and then some trailing impacts in the following day and week. There was a solid day of disruption in the stock market, and it was caused by when DeepSeek came out. DeepSeek is a Chinese AI company. So we have 2 main ones. There are actually a number. There's like Anthropic, which is a smaller US-based AI company, but there are 2 main AI companies in the US. That is OpenAI, which makes ChatGPT, and there's Google, which has their Gemini AI, and then there are some others, but those are the 2 main ones. And the US AI companies have really been the market leaders. It seems, at least historically, that they've been dominating the news headlines. They've been the only ones that have gotten any kind of recognition so far. But on January 27th, DeepSeek's AI assistant came out, and it quickly became the #1 downloaded free app on Apple's iPhone iOS store. And it was essentially curiosity. It spread on TikTok and other places like, wow, look at what this AI assistant can do. It's made by a new company that we've never heard of before. Is it any good? And apparently it was good enough to really stress a whole lot of US investors out that, oh, wow, within a few months, maybe a year. And more importantly, what was the triggering factor for the sell-off was it was a fraction, like a tiny fraction of the total cost to develop OpenAI and to develop all these different applications. This Chinese startup, a Chinese AI startup, had very low funding in comparison and turned around very quickly and created a AI assistant that was maybe not fully comparable to ChatGPT, but a very, very strong AI assistant. So because of those fears of, well, are we overvaluing this because it costs way more for us to develop it in the US than a Chinese company? So there was a lot of worries there. Eventually what happened is still developing. This is pretty new, just a week or so ago, but OpenAI started at least rumors, or I don't know if they were full out accusations, but they were saying that the company, Chinese AI company, DeepSeek, had trained its AI model using ChatGPT. So essentially was stealing its proprietary data to just learn, have its own artificial intelligence, learn off of the US artificial intelligence. Now, I have no insight into if that's credible or not. I also have no insight if that's legal or not. I am quite certain that if it isn't legal, there's no recourse that OpenAI could do. The Chinese government is going to throw any kind of lawsuit out and not care about that. But it's also somewhat ironic for those of you that have followed ChatGPT, especially last year when it came out. There was a whole lot of criticism of the company for training their AI model off of Google search and all of the news articles, New York Times and everything, that the Wikipedia, like all this data that had been put and it was proprietary and had a lot of info and money put into developing and creating this content. And then OpenAI scraped all of it and trained its AI model off of it. So it's a little bit of the pot calling the kettle black. It's like, well, OpenAI, it's okay when I steal data and train my model off of other people's proprietary information. But when someone else does it to me, especially if they're a Chinese company, like a rival competitor company, I don't know if it's okay. I think this isn't fair. So again, I don't have too strong opinions, but it is funny. I saw a lot of commentators saying that, and from an irony standpoint and a third party just observer standpoint, it's interesting to watch. The second headline I want to talk about was the Federal Reserve and inflation. The Federal Reserve met in January and left rates unchanged at 4.25% to 4.5% for their interest rates. At least I expected that. I think that was the market consensus. There's always a little bit of risk of they could cut, or they could raise, or they could cut a lot, or they could raise a lot, or they could do nothing. Those are the five kind of options. And most people, I believe, expected that they would do nothing, and then they did nothing. So it wasn't that surprising, and usually markets only react to surprising information, but there was still some movement around that decision. The Federal Reserve leaving rates unchanged essentially means that they're worried about inflation. They're right now on a cutting cycle, which means they're trying to reduce the restrictiveness of the economy. And so it was restrictive so that inflation would come down. And now that they are letting off of those restrictions a little bit, making it a little bit easier, a little more breathing room, the fear is inflation will come back if it's too quickly let go. And so they're taking it slow. And they had cut previously, and this is the first pause that they've done. So that did signal to the markets a little bit that the Federal Reserve is worried about inflation a little bit, which is scary for the markets. I'll say I understand it. I kind of expect inflation to come back this year, at least a little bit. Inflation started 2024 at 3.1% over here, and then it dipped down to a low of 2.4% in September, and now it's slowly risen back up. Some of it random chance, and some of it, I believe at least, expectations. So a lot of financial markets, inflation, all this stuff happens with expectations. A lot of it comes with expectations of Trump's presidency to be very stimulative and chaotic, and which will likely lead to inflation. A lot of his policies are very inflationary. cutting taxes is inflationary. Cutting regulation is inflationary. Tariffs 100%. If a news source or someone is telling you that the foreign governments pay those tariffs, that is not how tariffs work. They will definitely be borne by the consumer. All that is inflationary. So there is a good chance that this is one of the reasons the Fed has decided to keep rates a little bit higher in case inflation comes down. And they're still not at their target of 2%. Even 2.4 was too high based on what their target is. So we'll probably have a somewhat tough year ahead on inflation. And for those of you that invest with Silverstone Financial, we have started making appropriate changes and, well, at least slight tweaks, not full changes to portfolios to be a little bit more inflation hedged and protected for that, at least expectation on our front, what we would expect as base case. But hopefully there isn't inflation and everything works out. But that's just how I read the situation. Now, on other Trump news, there's DOGE, the Department of Governmental Efficiency, which is the new governmental agency. I'm not sure if it's technically official, but the one that Trump has appointed Elon Musk to reduce spending. They have started various ways of cutting expenses in a very chaotic way, I'll say. I won't comment too much on whether or not it's a good or bad idea, but it's definitely chaotic. And they have started with their offers to federal workers to quit. So essentially, early retirement. I don't think it necessarily has to be retirement. They just would have to leave the federal government employment and go find either retire or go find jobs in private companies. I can say I have seen this firsthand. I've had meetings with prospective clients that specifically got these offers and are trying to plan ahead for, should I take this offer? Are there downsides to take this offer? Can I retire now? This is, unexpected. I wasn't planning on being forced to go back to work in person full time, 5 days a week, especially when I had been used to doing it for being fully virtual. There are large changes being pushed in the federal government. So beyond it just may or may not affect any of you that are listening, these changes to employment status of so many people will have an impact on the economy. It could be positive, could be negative. It's impossible for me to actually say. It's very difficult to project these things, especially with there's so much random chance involved and autonomous decisions based on the federal government and how the employees are going to react. But it's interesting to watch, and I will keep you updated if we hear more. Third level of Trump news here is tariffs. So this wasn't surprising based on his campaign promises. Somewhat surprising to some people that didn't believe he would follow through. Technically, he hasn't followed through yet, but he is set to impose tariffs on Mexico, Canada, and China. I believe starting March 1st, but I'm not sure if that's still the date. In the past week, there's been so much flip-flopping back and forth that I don't actually know the US's official position, like what is actually going into effect, because there's been negotiations between different countries and concessions and not concessions and this and that. It's very difficult to know if these tariffs are going to be active or not, and when they're going to be imposed and what they're going to be imposed on. It's very, very confusing for anyone watching. Also, more confusing, which I understand campaign promises and I understand a lot of it, but I do have to point out the Canada and China tariffs, they are acting under the trade deal that Trump negotiated in his first term, and the terms haven't changed. And 5-6 years ago, he had been calling it the best trade deal ever or whatever. It seemed strange to me that he would impose tariffs on Mexico and Canada. Like, I get his rhetoric about, the tariffs on China or tariffs on the European Union or tariffs on other people that he doesn't feel like are paying their fair share. but Mexico and Canada are some of our largest trading partners, and we have free trade deals for a reason with them. And it seems like a very big reversal. And it seems disruptive in a way that's negative, at least from my perspective on how I read the markets and how the companies are reacting. Companies are not happy, especially about the Mexico, Canada ones. Those have been very disruptive to their business models. Yeah, that's all I have to say on that. Last one that I want to cover is true finance news that hasn't, this doesn't have, politics coming back and warping our finances a little bit. Was Vanguard, the world's largest money manager, I believe, or at least second largest, one of the biggest. They have $10 trillion in assets under management. It announced that it would lop off between 1 and 6 basis points. So that's 1/100th or 6/100ths of 1% per year in fees off of 87 funds that they manage. It includes many US funds, overseas funds. Most of the US funds, I believe, are bond funds, fixed income funds. It also includes actively managed funds and the index funds. Vanguard estimates that it'll save investors $350 million per year, just those small basis point changes. Now, Vanguard's already usually considered the lowest cost provider, period. They've had a long history ever since Jack Bogle back in the day founded Vanguard and pushed passive investing, low cost investing. Throughout their entire history, they've had cutting of fees and cutting of fees and cutting of fees. Every few years, they've cut fees. So it's not surprising that they continue to do so, especially as they have such a large base of assets, client base, that it's easier to scale. So the larger you are, the more of an advantage you have, and the easier it is, the cheaper you can make it. And the cheaper you make it, it's harder on smaller competitors that don't have the same scale as you. So it's really putting a lot of pressure into competitors like BlackRock or Invesco. They're both very, very large companies as well and have large asset bases, but it's cutting their revenue sources. And it's great for consumers that it's making investment less expensive and causing competition. And even if you're not using Vanguard or you're not using the specific funds that they cut fees on, it will have trickle-down effects on other funds that you may be using from BlackRock or Invesco or Fidelity or Schwab or State Street. There are so many, and with Vanguard being the leader in these low cost, hopefully it'll have a good impact on you investors. All right, so audience Q&A. I did see a couple questions come in. So the first one was is investing in gold a good choice right now? I guess that's going back to when we were discussing how gold performed quite well this past month. Gold in the past 2 years have performed under what I would have expected, especially with inflation up. Gold's a fine investment. In general, it underperforms stocks. It is usually used as a diversifier in portfolios. Almost all of our portfolios at Silverstone Financial use some level of gold, but when we say some level, it's like between 2 and 3%. It's not a large portion. I don't really recommend going out and buying physical gold bars. It doesn't make that much sense, at least in my opinion, that you buy a gold bar and then if you ever were to turn it into cash, you have to go to a dealer, and the dealers have pretty big spreads, which means like that's their profit margin. Like it's not an efficient investment versus if you buy like a gold ETF. So an ETF that holds gold on your behalf, you can exchange it for virtually free, very close to zero transaction costs on some of those ETFs. And the management fees on them are 0.25% per year or less. It just makes more sense for it to be a financial asset rather than a physical asset. The few times that I see people saying, well, I want physical gold is if, the apocalypse is coming or the government falls apart. At that point, like I've honestly said to clients, well, if you're worried about that, I would invest in bunkers, bullets, guns, and water rather than gold. Those will have a better impact. And so if you're looking at it as an investment, you should look at it as a financial investment and you should use it as part of a diversified portfolio and have it for a specific reason as a diversifier, rather than, oh, it's going to outperform stocks, which historically it doesn't, or, oh, it's going to do better than bonds for my retirement income. Well, gold doesn't pay a dividend, so it doesn't actually do that. So gold could be a good choice depending on your situation, and I would talk to a financial advisor about that. I had a follow-up question that just came in about GLD, which is, I believe, State Street Spider Gold ETF, and whether we use it. We don't use that one. It is the largest one historically. I think it's the first gold ETF. It's fine. There's nothing wrong with it. But I'm not making specific investment recommendations here, but BlackRock's IAU or IAUM are essentially the same fund, but it's formatted in a more efficient structure and has lower fees. The main reason you would use the Spider GLD fund over the IAU fund that is less expensive is if you are an institutional trader where you are day trading it and the spreads and liquidity is more important. But for you, I would go with the less expensive IAUM, which is what we use. But again, there are other implications that I may not know about your specific financial situation, such as if you have a gain on it, selling it and getting a capital gain is almost certainly not worth saving 10 basis points in fees. So yes, and talking about specific allocations and percentages, I can't speak to that over a webinar. Second question I had was, what are your thoughts on the future of crypto with Trump? I think Trump definitely makes crypto two things. It will likely both increase risk and returns. With weaker regulations, which means weaker commodity regulators and weaker SEC regulators and less fights from the Department of Justice, like all of those will lead to more innovation and in crypto, and will lead to quicker adoption and the chance of it performing better in markets. However, without those regulations and the regulators slowing it down and the Department of Justice going after crypto scams as aggressively as they did in the previous administration, there is more likelihood of consumer harm, and it makes it harder to invest in. The only crypto that we use at Silverstone Financial is Bitcoin. We use a Bitcoin ETF for it, and we have a small holding. Again, it is sub 3%, is part of the alternatives sleeve right next to gold for our portfolios. Again, that's not a specific recommendation to you. It depends on how you wish to build your portfolio and what you're trying to get out of it and your specific risk tolerance and time horizon and all that stuff. So crypto will likely perform better, but it will come with additional risks since there will be less consumer protections. Impacts on tariffs for the market. Honestly, we're going to have to see. I don't know. I think I talked a little bit about it already, and that's probably as far as I'll go, where I think if tariffs do go into effect, it is 100% a tax on consumers. That is how tariffs work. They are paid by the company importing it, and the company will maintain profit margins, and they will pass on, I would say on average, the majority of it. They could split and they absorb some of the tariffs, and then it's a tax on the corporations. But a tax on the corporations is a tax on the shareholders, which is usually consumers. So it's difficult to say tariffs in general will have a negative impact on the markets. With that said, tariffs are really interesting to see because they're popular with Americans, and most Americans don't find taxes popular. And historically speaking, we are in a very low tax rate environment, and taxes need to come up to make our national debt and all that stuff sustainable. So increasing in taxes is maybe not a good thing, but a necessary thing, in my opinion, at least long term. And so if tariffs are popular and it's a tax that most people don't understand, so they're happy to pay it, then maybe it's the best tax we can do. However, if those tariff taxes come in to basically that hurts consumers, and consumers are usually low income, middle, like it's not, most of those tariffs can be paid by the general populace, not the top 1%. If those then go into tax cuts for the top 1%, it won't necessarily lead to a better economy. In general, that is not good, in my opinion, tax policy. But again, tariffs are necessarily, could be good, could be bad, but it will definitely increase costs and will increase difficulties for companies, which hurts the market. I'll leave it at that. A follow-up question about the gold and such. Gross expense ratios. There's gross expense ratio and net expense ratio of a fund. A mutual fund or an exchange-traded fund, you need to pay the manager, the company that creates that fund. So, in example, State Street for GLD or BlackRock for IAU. Those funds have to go out and buy the gold and have to, in that case, I believe they have a physical like location with physical security with actual people with guns protecting the gold. Like they have to pay the salaries of that and the profit margins of the company. So those are what expense ratios are for. So you pay it for the fund. Even if you don't use a financial advisor, if you're using any kind of funds, those costs on top of the financial advisor. You can usually look those up by typing in the ticker name, so IAU or GLD expense ratio. Yahoo Finance is really good, where you can scroll down and see, type in IAU or GLD and find the one that has the lower expense ratio. Now, I'll also state, especially since there's lots of disclosures, the lower expense ratio fund will not necessarily lead to better results. However, the number one, academically speaking, in literature, like statistically speaking, the number one contributing factor to long-term returns is low fees on funds, at least, versus advisors. I might be biased, but advisors lead to provide other value other than just investment management. They provide psychological value and provide staying on top of your tasks and various tax efficiencies. So they're two different things, but especially fund managers, there are some more expensive funds that are active managers that might outperform. However, low cost is usually the better way to go. But if there are transaction costs like paying taxes to switch from one fund to the other, might not be worth it. Last question I have here, unless more come in, is is more of a private, personal question about this person's portfolio and how aggressive it is. And the question is, should I consider a more conservative portfolio with the changes from the government? And I'll say it depends on what changes you're referring to. It depends on your specific situation. It depends on if you're actually fearful. A lot of how aggressive you invest comes in two parts. Historically speaking, when you talk to an advisor, especially an older advisor that has been doing investment management for a long time, the historical way is risk tolerance. And risk tolerance is a large nebulous number. Usually how I describe it to clients is risk tolerance is a spectrum, and there are 2 points on the end of each of those spectrums. You have risk capacity and risk preference on the other side. So risk capacity is essentially your time horizon. When do you need to withdraw the money? And there are statistical measures to determine, all right, if I need it in 10 years, I can invest in this portion of stocks. I'm making it up, not an actual number, but 80% stocks, 20% bonds will lead to a good outcome for 10 years. Now, that is hypothetical, totally made up. Do not use that. But if you then needed to withdraw in 3 years, you'd have to be much more conservative. So that's risk capacity. Versus risk preference is how much risk do you actually personally want to take? Are you a risk taker? Do you just want a guaranteed return with no volatility? So that contributes to how you should be personally investing. And that would come down to a question of talking with a financial advisor and determining that. And if, depending on your financial advisor, they may or may not be doing a good job of tailoring that risk to be perfect, essentially, for your specific situation. It's somewhat of an art, less of a science, but yeah, talk to an advisor about your specific situation. All right, I don't see any other questions come in. Thank you all so much for attending this month's market update webinar for the month of February 2025. I hope to see you again next month. Have a great month.